dollar. This is the US dollar versus the Dixie index of developed market currencies. So the index is a basket of major global currencies that does include the Canadian dollar. And what's important here is not so much the numbers, those are index points, but it's the direction of travel. And you can see that this year, in fact, since late December, the greenback has been gaining value against that basket of international currencies. That brings us to Greg Taylor. He's got some thoughts. You think that rally is overdone?
Well, it feels like it's gotten a little ahead of itself, and it really all ties back to Fed expectations that we came into the year and the data started to surprise a little better, and everyone thought, well, maybe the Fed's not going to cut as aggressively as thought, and that is dollar bullish. So that's why we've got a bit of a bounce here. But if you look at the dollar on a longer term basis, it's really dominated against every currency. It's crushed the yen, it's crushed the euro, it's crushed the Chinese renminbi, and the Canadian dollar is not doing that well either against it. So it's been the king dollar for a number of years, and it feels like it's become a crowded trade. And as other currencies and commodity and countries start to do a little better, I think you're going to see people pull back a little bit from that dollar strength, and that's bullish for real assets. And I think that's where, again, investors need to start looking at real assets in their portfolios and something that is going to do a little better when the dollar pulls back. And because there's so much correlation in markets right now, for portfolios, you want to get something that's less correlated. And right now, everything is so focused on all these assets going one direction. You want something that'll go the other way in times of distress.
Is gold one of those real assets?
Well, I think that's what the gold bugs are hoping for, and it's one of these things that everyone's been waiting for gold to work, and everyone's saying, well, just wait for inflation to come, and then inflation came and didn't really do too much. But I think when you step back, gold's actually done not that badly.
These are, roughly speaking, record high prices that we're looking at now, correct?
Right, and I think the hope was that people would say, well, gold's going to go up to $2,500, but hanging over $2,000 an ounce in the face of that stronger U.S. dollar, I think it is a win. And when you look at gold and other currencies, it's done very well if you're sitting in Europe or England or Japan. And that's really comes back to the gold as a play on currencies going down. And I think that's, again, if you are starting to worry about the U.S. dollar and some weakness there, then gold is something you probably should have in your portfolio, or some other real asset that's going to benefit in times of U.S. dollar weakness.
Do shares of gold mining companies count as real assets? No. Right?
Well, that's an interesting debate, right. And certainly we've seen a big pullback in the valuations of gold miners because for a while that was the way to get exposure to gold, was to buy the miners. But with the advent of more ETFs and looking at spot gold, we've seen those valuations compress. And gold mining is a tough business, and we've seen a lot of companies stumble through this, and costs go up at times and so mining margins get squeezed. And I think the gold miners will benefit. There's certainly a multiplier effect when you get M&A and new discoveries. But I think you probably, with exposure to the commodity, you want to have a basket of the miners and also the physical gold.
Okay, speaking of miners, a couple of giants of the global mining industry, Rio Tinto and Glencore, have reported results. Both sets of results are disappointing to investors. And we want to bring you a quote from Jacob Stossholm. He's the chief executive officer of Rio Tinto. Here's what he had to say to our partners at Bloomberg News recently.
The energy transition is happening. Addressing climate change is happening more than any place in China right now. So the build-up of solar and wind, increasing the grid, building EVs is a very physical transition, and it requires more aluminium, more copper, and more battery materials. That is a kind of a physical fact, and I think that is a train that has left the station.
CEO of Rio Tinto making the case, and it's certainly been made before, that these companies are producing metals and materials crucial to the energy transition.
Yeah, absolutely. And I think those are great medium to long-term themes, and he's absolutely right on that. We just may have jumped the gun a little bit on some of these stocks last year and some of it's because everyone came into 2023 thinking that as much as North America and the Western economies really opened up after the COVID lockdowns, the next big economy to open up was going to be China. And there was a lot of expectations China's going to open up and we're going to see the same stunning growth that we got in North America. And they opened up and nothing really happened. And that's really why I think copper and some of the other commodities really pulled back, because there was a bit of a demand shock that it wasn't there as much as everyone thought. But now that's being reset. We're seeing how hard it is to get mines up and running with and political risk with First Quantum and their Panama experience. So I still think the demand is going to be there, but it's going to take a little longer as EVs and they need copper copper, as he mentioned. That's going to be there, but supply is really going to be tough to bring on. So with that mismatch, I still think there's a bright future for commodities going forward the next few years, but we kind of had a reset because of the stumble with the Chinese economy last year.